In the last few hours, silver didn't just climb, it snapped. It pushed through the kind of price level that used to feel impossible. It shattered the $90 ceiling like it was made of glass. But while the Western media is scrambling to explain the chart, something even crazier is happening on the other side of the planet. Something that makes the price action in New York look like a distraction. The physical market in Asia, specifically in Shanghai, just started paying a jaw-dropping premium that the paper traders in the West can no longer ignore. We are talking about a divergence so violent, so undeniable, that it threatens to break the entire mechanism of global pricing. This is the real story today, not maybe someday, not in the long run, right now. The physical price is threatening to drag the paper price up like a stubborn anchor that has finally been dislodged from the seabed. And if you have been waiting for the moment where the two markets stop pretending they are the same thing, where paper promises and physical atoms finally divorce, you might be watching it unfold in real time. So what exactly is happening? Why did the price suddenly wake up and choose violence? Here's the truth. The arbitrage window is broken. In a normal market, if silver is expensive in China and cheap in New York, banks buy it in New York and ship it to China. They profit from the difference, and the prices equalize. That is how the world works. The mechanism just failed. The premium in Shanghai blew out to record levels, and the metal didn't move. Why? Because you can't ship what you don't have. The vaults in the West are effectively empty of available metal. The paper market is trading billions of ounces of claims, but the physical loading dock is collecting dust. This is a silent alarm. It is the sound of a market realizing that the emperor has no clothes and definitely no silver. Now, I know it feels wild to even say this out loud. Silver is hovering near $90. About a year ago, we were fighting to hold $30. That is the kind of move that makes smart people do dumb things. It makes cautious people chase the top, and it makes confident people sell too early because they are terrified of the height. Don't let the green candles intoxicate you. Volatility is the price of admission. And with silver, it isn't a gentle roller coaster. It is a rocket with loose bolts. We are entering the face-ripping phase of the cycle, where the market doesn't just beat the shorts, it humiliates them. Bridge phrase. So, in this emergency breakdown, I want to make sense of exactly why the arbitrage failed, expose the weirdest threat to your stack that is hiding inside your own home right now, and show you the mathematical formula that proves mining stocks are about to go absolutely berserk. Let's start where the stress is highest. The market always tells the truth where the pain is. Overnight, the story wasn't just silver is up. The story was that the physical price in Shanghai surged to a record level, and the gap versus the so-called spot price in the United States blew out into the kind of premium that makes seasoned traders sit up and blink twice. Think about what that actually means. It means buyers over there weren't negotiating. They weren't waiting for a dip. They weren't saying, let me see if the Fed cuts rates next week. They were bidding for real metal right now, and they were willing to pay a massive markup, sometimes 10% to 15% above the Western price, just to secure delivery. They tell you that silver is a global market with one price. The reality is, the market is fractured. In a functioning economy, this shouldn't happen. It's called arbitrage. If silver is $90 in New York and $105 in Shanghai, a bank like JP Morgan or HSBC should buy it in New York, fly it to Shanghai, sell it for $105, and pocket the risk-free profit. This buying in New York and selling in Shanghai naturally pulls the prices back together. That is the gravity of finance. But today, the gravity is gone. The gap is widening and nobody is closing it. Why? Because you cannot ship a paper contract. To capture that profit, the banks need 1,000-ounce bars. They need physical metal sitting in a vault in New York, ready for export. The fact that the premium is staying wide tells you one terrifying thing. The metal is not there. The arbitrage window is broken because the Western vaults are filled with ghost silver, claims, leases, and rehypothecated IOUs, while the East is demanding atoms. The West has run out of ammo. The paper anchor that held the price down for decades has snapped, and we are now drifting toward the true physical price set by Shanghai. This brings us to the second layer of the deception, the volume. On a single recent trading day, the volume of silver traded in the Western paper market was measured in the hundreds of millions of ounces. Sometimes we see 1 billion ounces of paper silver trade in a 24-hour period. Let that sink in. 1 billion ounces is roughly the entire annual mining output of the planet Earth. Are we supposed to believe that every single ounce of silver mined in Peru, Mexico, and China changed hands in a single Tuesday afternoon? Of course not. They tell you this is liquidity. The reality is, this is a casino. Imagine a concert venue that has 100 seats, but the ticket office sells 10,000 tickets. How does this work? It works as long as 9,900 people just want to trade the tickets back and forth outside the stadium for a profit. As long as they don't try to go inside and sit down, the game continues. The price of the ticket fluctuates based on sentiment. But what happens when the music starts? What happens when the crowd realizes the band is playing? Suddenly, 10,000 people try to rush through a door that only fits 100. The price of the paper ticket, the speculative bet, crashes to zero, and the price of the physical seat, the real asset, goes to infinity. That is the silver market right now. We have 100 ounces of paper for every 1 ounce of registered physical metal. For years, the banks used this massive paper volume to smash the price. If the price got too high, they would just print more paper tickets and flood the market. But that trick only works if nobody asks for delivery. With the Shanghai premium blowing out, the world is finally asking for delivery. The crowd is rushing the door, and the ticket sellers are terrified. Now let's talk about why the crowd is rushing the door. It's not just investors scared of inflation. It is something much more powerful: inelastic industrial demand. For the last decade, you heard analysts say, solar panels use less and less silver every year. They are thrifting it away. That was true until 2024. Now, the trend has reversed violently because of a new technology called TOPCon, tunnel oxide passivated contact. Here's the simple version. The old solar panels, PERC, were efficient enough. The new solar panels, TOPCon, are significantly more efficient, but they require 50% to 80% more silver paste per cell. The solar industry didn't thrift silver away, they doubled down on it. Why? Because silver is the most conductive metal in the universe. You cannot cheat physics. If you want maximum efficiency, you pay the silver tax. This creates inelasticity. If you are a solar manufacturer like Jinko Solar or First Solar, and you have $1 billion of orders to fill, you don't care if silver is $30 or 100. Silver is a tiny fraction of the total cost of the panel, but without it, the panel does not work. You must buy it. You are a price taker. This is the nightmare for the short sellers. Speculators will sell if the price drops, but a solar factory cannot sell, they must buy. They are a black hole sucking 200 million ounces a year out of the market, regardless of what the Fed does, regardless of interest rates, and regardless of the chart pattern. When you combine an inelastic buyer, solar, with a broken arbitrage of Shanghai, you get a price explosion that cannot be contained by paper selling. Now, let's address the question that is driving everyone crazy in the comment section. If silver is at $90, why are my mining stocks still stuck in the mud? Why aren't they flying? This is the miner lag. And while it feels painful, it is actually the biggest opportunity on the board. If you understand the math of operating leverage, most people treat mining stocks like they are just silver with a beta. They think if silver goes up 10%, the stock should go up 20%. But miners are businesses, and businesses have fixed costs. Let me give you a formula that will change how you look at your portfolio. Imagine a mining company. It costs them $20 an ounce to pull silver out of the ground, all in sustaining costs, AISC. This cost is sticky. Diesel, labor, tires, these things don't triple overnight. Scenario A, silver is at $30. The miner sells for $30. Cost is $20. Profit to Dwarm $10 per ounce. Scenario B, silver goes to $60. It doubles. The miner sells for $60. Cost is still roughly $20. Profit, or almost $40 per ounce. Look closely at the math. The price of silver went up 100%, 2x, but the profit of the company went up 300%, 4x. Scenario C, silver goes to $90, current levels. The miner sells for $90. Cost is $25. Let's assume some inflation. Profit are $65 per ounce. The profit is now exploded by 550% compared to the starting point. They tell you the miners are lagging because they are bad businesses. The reality is, the market hasn't done the math yet. Right now, Wall Street is terrified. They are scared of inflation, scared of energy costs, and scared of nationalization. So they are ignoring the cash flow. But when the next earnings season hits, when these companies report that they are printing more cash in a quarter than they used to make in a decade, the repricing event will be vertical. We saw this in the 1970s. We saw this in 2002. The metal moves first. The miners look dead. And then, in the final third of the bull market, the miners go absolutely berserk. We are sitting on a coiled spring. The tension is building, and the catalyst is simply the next quarterly report. Finally, we need to talk about the authorized participant, AP mechanism. This is the plumbing behind the broken arbitrage we talked about in section 1. How exactly does the silver leave the west to go to the east? It happens through the ETFs, specifically SLV. Most retail investors think SLV is a vault where they put their silver for safekeeping. Wrong. SLV is a buffer stock for the bullion banks. Here's the mechanism. When the price in Shanghai is $10 higher than New York, a bank like JP Morgan, who is an authorized participant, sees free money. They buy shares of SLV on the stock market, paper. They go to the ETF vault and swap those paper shares for physical bars, redemption. They take those bars out of the London, New York vault. They ship them to Shanghai or sell them directly to a solar factory. This is why the ETF inventory is falling even as the price rises. Normally, rising prices attract metal into the ETF. But right now, the ETF is being cannibalized. It is the cheapest source of wholesale 1,000-ounce bars on the planet. The APs are stripping the copper wiring out of the walls of the Western financial system to sell it to the East. The eligible trap. To hide this drain, the exchanges play games with the data. They point to the eligible category and say, look, there are still 200 million ounces in the vault. But remember, eligible means not for sale. That is private metal. It belongs to a family office, a sovereign wealth fund, or a long-term holder. It is just parking there. The registered category, the metal actually available to stop the squeeze, is at historic lows. We are watching a slow-motion bank run. The paper price in the West is being used to trick you into selling, while the physical mechanism, APs, is being used to move the real wealth to Asia. Don't be the retail investor left holding the paper receipt when the vault is empty. We have arrived at the conclusion. We have covered the broken arbitrage in Shanghai, the deceptive volume of the paper market, the inelastic hunger of the solar industry, and the explosive mathematics of mining stocks. But I promised you earlier that we would talk about the Wertmieterhaus, the weirdest threat to your silver stack, the one hiding inside your own home. It sounds like a joke, but it is actually the most accurate market indicator I know. It is the spouse indicator. For years, if you were stacking silver, your spouse or your family probably looked at you like you were insane. They called it a pet rock. They asked why you weren't buying Nvidia or Bitcoin. You were the contrarian. But now, with silver breaking $90, suddenly the stack isn't your crazy hobby. Suddenly it is our investment. When the price goes parabolic, the people who mocked you will suddenly discover a deep emotional attachment to those shiny bars. Why does this matter? Because this psychological shift from ridicule to greed marks the transition of the market. We are moving from the smart money phase, accumulation, to the public mania phase, distribution. The threat isn't that they will steal it. The threat is that they will pressure you to sell too early. They will see the paper profits and scream, sell it, we can buy a new car. Do not listen. We are not here to buy a Kia. We are here to preserve generational wealth during a currency collapse. So, how do you navigate the chaos of the next few weeks? Here's the battle plan. 1. Watch the East, ignore the West. The price on your TV screen is a lagging indicator. It is the paper anchor. If you want to know the real price, watch the Shanghai Gold Exchange, SGE, and watch the physical premiums. If Shanghai is trading at $105 and New York is at $90, do not sell at $90. That is a discount. The West will eventually be forced to snap up to meet the East. Do not donate your wealth to the arbitrage bots. 2. Hold the miners for the earnings. If you own mining stocks, this is the hardest part. You are watching the metal fly while the stocks crawl. It is frustrating. It feels broken. But remember the formula. Operating leverage. The market is waiting for the proof. That proof arrives in the next quarterly earnings call. When these companies report 500% profit growth, the algorithmic trading bots will have no choice but to reprice the entire sector overnight. The biggest mistake you can make is selling the coiled spring right before it releases. 3. Do not trade the volatility. They will try to shake you out. They will dump 1 billion paper ounces at 4 a.m. to crash the price by 5. This is not a sell signal. This is a desperation signal. In a bull market, the surprises happen to the upside. Sit on your hands, lock the vault, turn off the screen. I want to leave you with this. There is a famous saying, history doesn't repeat itself, but it rhymes. We are rhyming with the 1970s. We are rhyming with the fall of every fiat currency that has ever existed. But this time, it is different. Because this time, we have technology like TOPCon and AI that needs the metal to function. We have a geopolitical East that wants the metal to break the dollar. The window where you could trade paper for physical metal at a suppressed price has been open for 50 years. It has been the greatest gift of our lifetime. But look at the premium in Shanghai. Look at the empty vaults. The window is closing. The price of admission to the physical reality is about to go vertical. Don't be the person standing outside looking in, holding a fistful of dollars that nobody wants. The mainstream financial news will tell you this is a bubble. They will tell you to sell. They will try to guide you back into the paper casino. We know better. If you want to navigate this transfer of wealth with clarity, if you want to stand with the few who understand that price is nothing and value is everything, then you know what to do. Join us, subscribe, and turn on notifications. Because the next time I speak to you, the arbitrage gap might be closed, and the opportunity will be gone. Stay disciplined. Watch the earnings, and I'll see you on the other side.